And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the second best day of the week. Michael Lebowitz joining me this morning as well. Got a lot of stuff to get into with you today. Kind of economic news has been fairly mild over the last couple of days. Not any really big reports. We did have industrial production yesterday as well as manufacturing, and both of those came in very, very strong. So industrial production and core durable goods were very strong. So you strip out aircrafts and motor vehicles. They were very strong, above expectations. And again, so it just kind of continues to show that, you know, the part of the economy that's benefiting from all these data center build-outs is continuing to benefit from those data center build-outs. That's a lot of capital expenditures. And kind of the subject of this weekend's newsletter is talking about these economic cycles that we have. And part of what's happening within the economy right now, this whole reflation trade, is this idea that all this technological spending for these data centers is flowing through to the companies on the base materials industrial side that are building out these data centers and facilities, et cetera. And you know, that's why stocks like Caterpillar have been doing well, others. That's been that kind of infrastructure chase that we really kind of started talking about last year, was this idea that infrastructure would kind of be a place to be. So again, that's all kind of working on a process that's showing up in the data now. Overall, though, the GDP growth estimates are continuing to kind of run in that 2%-ish range outside of the Atlanta Fed. Atlanta Fed, they're currently at 3.6, down from like 4.2, but most other indicators are around the 2.3 to 2.2 range for GDP growth for the fourth quarter. So we'll see how that comes in. But, you know, as we've talked about before, so goes economic growth, so goes earnings and those type of things. So it's important to see this continuation of stronger economic growth if we're going to have a continuation of a stronger market. Outside of that, you know, one of the things that has been interesting as late as, you know, Wall Street has been very visible about their conversations about software as a service stock and, you know, stocks, right? So these software stocks, they've been under a lot of pressure. That was because AI is going to replace all these software as a service stocks, and people won't need them anymore. And it's been interesting because while Wall Street, or I shouldn't say Wall Street in particular, but it's been a lot of the mainstream media, the persistent purveyors of doom. It's, you know, the crash is here. Look at these software stocks are getting killed. AI is going to replace everything. It's been interesting because retail investors have been buying software as service stocks at the fastest clip on record. So while they've been going through this sell-off, retail investors have been buying these stocks kind of hand over fist. And they're probably not wrong. There is going to be a few of these companies that certainly go away, and we've talked about this before, but those valuations for a lot of those companies have been deeply discounted now. And there are companies that have millions of man hours on working out bugs and issues and customizations of programs, et cetera, for those software programs they provide. And trying to just go to, you know, AI and say, develop me a CRM as an example, you know, you're gonna have to deal with all the bug issues that come out of that when that's already been accomplished by some of these other companies. So, you know, companies like Salesforce, ServiceNow, Adobe, I mean, you know, AI is not gonna potentially replace a DocuSign anytime soon, considering how much we rely on transmission of contracts now back and forth through DocuSign. That's going to be a very hard process to replace in very short order. These companies have good revenues. So maybe retail investors are right. They're starting to kind of dig through the rubble. As we talked about before, you know, when Wall Street doesn't want something, that typically tends to be the time that you want to start digging through the rubble to see what opportunities exist. So anyway, it's just something worth considering and something to look at. And again, this is where, you know, kind of the stock selectivity becomes very much more important in your overall portfolio. Okay, with that, let's talk about what you need to know before the bell this morning. Markets were up pretty strongly yesterday morning, ran right into the 20-day, the 50-day and the 20-day moving average, which are sitting right on top of each other right now. Sold off right a little bit to the close, but closed up right next to the 50-day moving average. Now this morning, futures are pointing down just a little bit. So we'll see, kind of, if the market kind of, gets some buying power coming in kind of after the open, as we saw as we've seen previously, we've seen this market open lower and then immediately buyers show up and begin and kind of be buying the markets. But, as of right now, the market's just, again, really boring. It's just going nowhere right now. Still kind of continuing to grind higher along this 100-day moving average, but it's just a very slow process. Now, the one thing to pay attention to, though, is the Dow Jones. The reason to pay attention to the Dow is only this, is that while the Dow's been a very nice uptrend, sitting above the 20-day moving average, it's actually performing better than the S&P 500 right now. This index has been up for 9 months in a row. Going back to 1900, there are only 7, 8, 9 periods going back to 1900 where you've had 9 months or longer of a stretch of the Dow being up every single consecutive month. So we're getting pretty long in the tooth here where potentially we're going to get some corrective action in the Dow. And if we get some corrective action in the Dow, it's likely going to spill over into the NASDAQ and the S&P 500 as well. But again, I would just pay attention to kind of the length of these current rallies. Furthermore, if you take a look at breadth of the market, 65% of the constituents in the S&P 500 are all trading above their respective moving averages. So that's a very high level. Now, good breadth, right, is good. So if we have a market that's rallying on improving breadth, that's good because that improving breadth is supportive of the rally. However, it's kind of a double-edged sword. When you get all the stocks now trading above their moving averages, generally they're all getting very overbought. That's where corrections occur. So when you have very high levels of breadth in a market advance, that's where corrections are generally going to kind of set themselves up. And again, we're not talking about a major crash or anything like that, but a pullback of 3, 4, 5% to kind of reset that table a bit would not be surprising, and particularly given kind of the length of the run in the Dow in particular, just as a proxy, that would seem to be a more near-term event than not. So again, as we talked about before, it doesn't mean go sell everything, go to cash, doesn't mean the market's about to crater, but it does suggest that there is some risk building within the overall market. So don't forget to take profits, don't forget to rebalance your portfolio, just those types of measures to try to navigate whatever correction does come, which will be an opportunity to put some capital back to work. But if you don't sell some stuff now, particularly in very overbought extended areas of the market like we discussed on Monday, then you don't have any cash to reinvest at lower prices. So just something to think about. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Say the word annuity and people cringe, but here's the truth. Annuities aren't the enemy of your retirement. Wall Street billionaires don't worry about running out of money. You do. What you're being told about annuities is wrong. Our next Candid Coffee will show you how the right annuities can reduce market risk, create lifetime income, and even replace bonds in today's volatile environment. Join Danny Ratliff and me for Candid Coffee, Saturday, February 21st. Before you dismiss annuities, get the facts and a plan built for your retirement reality. Candid Coffee, Saturday, February 21st. Register today at realinvestmentadvice.com. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, good morning. Before we get over to Michael real quick, I'm sure he's going to want to comment on what I'm going to say first. Walmart just reported earnings a little bit ago. And again, Walmart's one of these companies that we've been kind of watching a little bit as of late very closely as kind of a proxy for what's going on, kind of with the consumer, but also a function of the fact that staples have become exceedingly overbought. It's interesting, and we talked about this earlier this week, that, if you listen to these constant purveyors of doom, that are out there, is like, everything's going to crash, the market's going to crash, the world's coming to an end, etc. They point to technologies like, say, look how overbought these technology stocks are. And then, of course, you get the immediate analogies back to 1999. And, the last time tech stocks were this overvalued in 1999, we had this massive crash and everything ended. Well, it's interesting because you look at staples, they are now as overvalued as they were in 1999. So, but you don't see these same people around like, look at staples, they're as overvalued. And of course, there was a huge revaluation of staple stocks in 2001 and 2 when the markets declined. And so it's always important to kind of separate narratives, but we've been watching staples because staples are, and Mike just wrote an article about this recently, is that staples really aren't value stocks anymore. They are trading very expensively. We talked about this numerous times on the show, showed you heat maps, etc. But Walmart's going to trade down about 2.5% this morning when it opens. Earnings came in at a $190.7 billion, adjusted EPS of about 74 cents. Interestingly enough, they have also announced a $30 billion stock buyback program. So this is new for Walmart. They haven't done that before. But so they're going to enter into the space of more stock buybacks, which is, kind of where things are headed. But it is interesting because, again, this has been one of those companies that has been on a tear, particularly since the beginning of this year, has just gone up very sharply. But as Mike and I have talked about, these valuations, you're talking about Walmart, which trades at a 48 times forward PE, so it's not cheap. 48 times PE, that's more like a tech stock that's growing at 20% a year versus Walmart that's growing at 4.5%. So again, just some, we get to these narratives in the markets and we get to these momentum chases, and this is why it is important. It seems like fundamentals don't matter, but fundamentals do matter over time. And if you're overpaying for earnings growth to a more extensive degree, and again, full disclosure, we're long Walmart in our portfolios. We own that for a reason because in defensive periods of the markets, those stocks tend to do well. So we own part of that defense, but it is getting expensive. And it is something that certainly needs to be taken into consideration. Mike, any comments on that?
No, that's exactly right. It's, thinking about their earnings, I'm thinking about it like a high-tech growth stock. Like, okay, they beat earnings by a penny and revenue by a little bit. That's not good enough. It's good enough if they had a PE of 15, but they're priced like a high growth company. And Lance, I would argue they need growth of 30 to 40% to justify its valuation. Well above not even what they're doing, but what they're capable of. They're not in a business where you can get that kind of growth anymore. It's very mature, very competitive. I think this is why we started the year. Our biggest concern was not Iran, it was not AI, it was not these other things, it was valuations. And Walmart's a perfect case of why valuations matter. It almost just puts a cap on the price. It doesn't put a cap on it, but it's like this soft cap on the price of the stock. Yeah. And even if they kill it in earnings, it's never going to be good enough. So the only question in my mind with Walmart now is, can this rotation towards quote unquote value stocks continue? Because Walmart is kind of the poster child for that, and it will keep going up if that continues. But valuations are something, worth keeping an eye on.
Yeah, and by the way, we're not saying that Walmart's earnings were bad or anything else. Walmart's earnings were good. Their sales growth is so consistent. I mean, you can almost just draw a trend line for earnings growth and just out into the future and say that, they're going to grow at 5% a year on sales growth going into the future because that's what they do. It's just very consistent growth over time. It's a very good company. There's absolutely nothing. That's why we own it. It's a great company. Costco, it's a great company. But at times, the price just gets deviated from kind of the underlying fundamental trend. So that price has been correcting. The Walmart's been selling off for the last 3 days going into earnings. So the market was already looking at the price of Walmart saying, even if their earnings are good, they're not going to be good enough to support the price where it is. And so you're getting that bit of a correction here in the price. And that should not be surprising. And this will be a good opportunity to add, if you own Walmart, this will be a good opportunity to add to Walmart at some point. But it may have to go through a bit of a corrective phase to kind of realign the price back to what's happening with fundamentals. But again, nothing wrong with the company. It's a good company, and the earnings were good across the board. Certainly suggests the consumer's hanging in there. Mike, I haven't had a chance to read the entire thing, but did you see any notes about comments about foot traffic or anything like that yet?
I didn't. I just saw the summary of it.
Okay.
But it's worth adding, Lance, that we did trim Walmart last Thursday or Friday.
Yes.
Again, not because it's not a good company, because its stock price has just gone way too far, too fast. And it's exactly what you said. Its growth is so predictable. It's the odds of it hitting what the market is pricing in is ridiculous.
Well,
So,
it will eventually. I mean, it'll
Right.
grow into it eventually, but it could be a very long time at 48 times
Right.
earnings, right?
right. I wrote an article about this a month ago. We've had conversations for the last 5 years. We get these periods of these rolling bubbles. And now it's really interesting. The last one was silver. Before that, you had things like meme stocks and altcoins and NFTs and the GameStops and, all kinds of different bubbles along the way. Isn't it interesting that we're now having a bubble's a strong word, but a pseudo bubble in staples?
Yep.
Like, that's one thing I didn't have on my bingo card for this year.
Exactly. Well, and it's interesting because even if you flip over to industrials as an example and take a look at John Deere as an example, there was a comment about John Deere in the chat, but it's also kind of the same thing. Deere has had declining sales for the last 5 years, and here's another stock that's trading at almost a 30 times forward PE with declining sales and declining EPS over the last 3 years. There's the bet is that all this is going to reverse now because of all this CapEx spending that's coming in from companies. But you're seeing the same thing also with companies like Caterpillar. It's been on a huge run. It's gone. In these stocks, you look at them, they're almost going parabolic in some of their trading. So it's just, this goes back to sales growth on Caterpillar has been flat for 3 years. EPS has declined over the last 2 years. They're engaged in a lot of share buyback, so they've been reducing their shares outstanding, and they still have declining EPS. So it's but the price is going very up very quickly, and it's trading almost 30 times forward PE as well. So these stocks are trading at very high multiples, but these areas in particular have some of the lowest rates of earnings growth, which is going to make this whole. And again, I get the sentiment, I get the whole idea of the chase here, right? It's this reflation trade, and we're going to have all this spending, and so everybody's going to need tractors to go move dirt to build these data centers. That's a true statement. Nothing wrong about that. But the question is the price getting too far ahead of the reality of what that spending is actually going to look like?
Right. And I just feel like very few people are looking at valuations. They're chasing themes, right? The theme is value. And if it's a staple, it's value. If it's a energy, industrial, or material, it's economically sensitive. So that should be doing well. And they're chasing these themes, but not looking at the underlying stocks. And I've been actually working on an article maybe in a week or two on real value. And I run a scan towards the end of it to find companies with low PEG ratios, low forward PEs, and low trailing PEs. And for the most part, they're companies, you've heard of some of the companies, but they're companies most people haven't heard of. It's not the ones in the limelight that are the real value. It's really hard to find true value unless you go look in the technology sector. NVIDIA. Google, there's value. There is actually value there, but it's called growth, so no one calls it value. And that's the weird market dynamic that we're in, and we're all forced to participate in it, to trade it, but it's also incumbent upon us to understand it and recognize its flaws, like we're talking about with Walmart. That great company, but does it matter when you're paying so much for their future earnings and revenues?
No, it's absolutely true. And again, it's just there's going to be benefit from all this data center build out, all this construction. Absolutely true. The question becomes, and this is for investors, the question you have to ask yourself is, has that already been priced? And here's a price. This is a monthly price chart of Caterpillar. So this goes back to basically about 2008. And Caterpillar grows at about the rate of the economy over time, and because that's the economic production. But you can see here at the end, just starting kind of midpoint last year, it has gone just parabolic to the upside. And this is that chase for infrastructure, and everybody's piling into that chase now. Retail investors are chasing it. You've got a lot of speculation in the sector. But again, if you don't need to move anything, Brent, just hold on. But if I scroll down, this is their shares outstanding. Been a lot of stock buybacks, and again, you can see earnings revenue. Sales growth, which is their top line, has been virtually kind of flat. It increased in, about 3 years ago, but it's been flat over the last 3 years, and EPS has actually been kind of weakening. So, again, there's a lot of expectation here and a lot of hope, but the problem is that when you're paying these kinds of valuation structures, it becomes more problematic. Here's Deere, just as an example, also. Has just gone, just kind of straight up as well. And these things are trading, 3 standard, 4 standard deviations above monthly moving averages. So you're eventually going to get a correction in price, and that correction will be at some point, just a question of when, can be fairly significant. So again, as we talked about before, don't forget to take profits. Don't forget to rebalance your risk. Nothing wrong with these companies at all. The theme is there. It's just they're getting a bit ahead of what reality is likely going to be. Okay,
Lance,
go ahead.
Lance, real quick, you put out a great article, I think it was Monday, where you just looked through all the sectors. And it seems like 6 or 7 of them had graphs that looked somewhat like Caterpillar. Right? Where they were kind of these steady trends, and then they just ramp up like a meme stock or a crypto or a high tech stock. And that's what we're talking about, that they're not behaving like they typically do. And, it's just part of this passive chase. They're not chasing value stocks, they're chasing value themes, regardless of whether they're value or not, but they're chasing themes. So just beware what's going on and how it drags the largest stocks in those themes up with it the most.
Okay, so I thought I wanted to show you this real quick, Mike, because I did a Fox Business interview talking about this. Just stays with the value theme here. We got a lot of stuff to get into this morning, guys, so just hold on with us. We're with the chat. So I was on Fox Business yesterday with Charles Payne, and we were talking about this value growth rotation issue, and he brought up a really great chart, and I want to share it with you. So can you bring up the pie chart and then the list of holdings next to it? Just can you zoom in on that kind of center column? Yeah. So this is IVE. So this is the iShare, and actually I need the other part right next to that. So this is IV. So IVE. This is the iShares S&P 500 Value ETF. And so if Brent can get me the column right next to that, I know you are. There it is. So you'll notice that the top holdings of IVE, this is the value index, is Apple and Amazon. So, we've talked about this before, is that, everybody's trying to keep up with the momentum in the market. And what happens is that you drag in over time growth stocks into these value indexes. And this is just kind of a good indicator of this, is that you see and again, as Mike's talked about before, there are some value here, but typically we look at Amazon and Apple as growth stocks, not really value stocks. And then, of course, you see ExxonMobil and Walmart, but your 2 biggest holdings in the index are Apple and Amazon. So just this is also one of the challenges that we have to do as investors, is really dig through, especially if you're just buying ETFs. Just because you buy a value ETF doesn't necessarily mean you're buying value. That's when we have to kind of really dig through and understand what we own. So anyway, Mike, so real quick, yesterday in the FOMC released their minutes. Was there anything of note in the minutes? I did see they tended to lean a bit more dovish than kind of what I think the market initially, or market kind of took away from the last meeting with the Fed. The minutes seemed a little bit more dovish. What were your thoughts?
Yeah, they're kind of all over the place. So the tough part with the minutes is that they release everyone's views. And, you can read through them, and there are views that are somewhat or very dovish. There are views that are somewhat hawkish. And within the minutes, when you read the minutes, you get the impression that they could lower rates several, I think they said several times. But again, that's one person speaking. And there's a couple people that think that there's a case to be made that rates could be raised later in the year. and they're basically hedging every which direction rates could go. But it appears that the majority think that rates are at a good place right now. They're going to stay where they're at until there's further data that tells them that inflation is coming down or the labor market is weakening further. But it wasn't very insightful. The markets really didn't move on it, I think, because it's kind of a known thing at this point. So again, we go back to waiting on the next round of data. What does it look like?
True.
And I think that will kind of steer the Fed members, but they're not in agreement. Again, there's doves, there's hawks, and there's a bunch of kind of people in the middle that everything is just right, but not too much from this one.
Again, we just kind of live from one meeting to the next. So, it's just this is the way the markets work right now anyway. So it's always worth at least noting something about it. Not sure there's ever anything really that important that comes out of the meetings, but,
But sometimes they do use that FOMC, the minutes, to release new stuff, like to hint about stuff. They didn't use this one at all to hint about anything.
Okay.
And remember, we're getting closer to Powell's end. His term ends in May. So we're only 3 months off. There's probably only 2 meetings between now and then. So what Warsh is, when Warsh starts speaking publicly or testifying to Congress to get nominated, that'll probably be a little more insightful for the markets.
Right. So, all right, well, let's talk about Lance said nobody cares except for Michael Lebowitz about Fed minutes. So probably. Anyway, so Mike,
no one cares until they need to care.
Exactly right. So Mike, you wrote an article. It was interesting yesterday talking about Ray Dalio when he was at the Davos meeting. And of course, there's been a lot of comments about this that's been running around social media as of late. Of course, all the persistent purveyors of doom, jumped immediately on these comments like Ray Dalio says. Tell us what he said and let's talk about it a little bit.
Well, if you just kind of look at some headlines, especially on social media, he said the world's coming to an end next Tuesday.
Okay.
It was an imminent fiscal crisis, hyperinflation kind of message. And look, I respect Ray Dalio a lot. He's very smart. He runs or ran the world's biggest hedge fund. Guy knows what he's doing and what he's talking about. He's written several books. So the
only problem with that is, and I think I think Ray Dalio is one of the most overhyped hedge fund managers in history. I mean, the 60/40 index trounced his all-weather fund for years.
Yep.
So, I mean, it's great that he run a huge hedge fund, but his performance, you've been better off just buying a 60/40 index.
Yeah, I don't, and in fact, we have that in our daily commentary, the performance. But what's interesting is, some of the quotes, hyperinflation is coming fast, America's going broke, dollar collapse is imminent. He didn't say that. Basically, what he said is some of the same stuff we've said. We're on the slow road to trouble, right? We can't keep running more debt than the economy is growing. Eventually, and he uses words like eventually, there won't be buyers of the debt, that yields will have to rise. Basically, he said, look, America's been drinking. We got a drinking problem. And if you keep drinking, eventually your liver's going to give out on you and you're going to have all kinds of issues. So we need to slow down on the drinking. Not stop, but just slow down on the drinking and some other things. And it's just funny the way social media amplifies everything to a point where it just doesn't even make sense what he's talking about. But he's basically saying the same thing he's been saying for 20 years.
I know that's exactly my point, which is, and this is also too the other problem. So I wrote an article about this previously. Here's a list of dates going back. March 15, hedge fund Dalio thinks that Fed can repeat 1937 all over again. January 2016, 75-year debt supercycle is coming to an end. 2018, Ray Dalio says economy looks like 1937. 2019, Ray Dalio says significant risk of U.S. recession. 2022 warns of perfect storm for the economy. Dalio says U.S. is going to have a debt crisis in 23. This has been a consistent theme of him. And even he was interviewed. This is the interesting thing. He was interviewed And he said, yeah, one of the biggest mistakes occurred in 1981-82 when I became convinced that the U.S. economy was about to fall into a depression because of the debt. So, this has been his view for 40 years. And the problem is everybody keeps running to this view going, oh, look, Ray Dalio said this is about to happen. So, the world's going to end and nobody wants to own our debt, et cetera. We keep hearing these same stories, but none of it's true. And more importantly, none of it has come true because the economy is constantly growing and evolving. And everybody says, oh, look, we're running a deficit. Yeah, we've been running a deficit for 40 years. And, yes, debt levels are high. Nobody's arguing that debt levels are high, but that doesn't mean the economy is going broke, because in order to be bankrupt, that means that you don't have any assets. But the U.S. has has trillions of dollars worth of assets. And this is the part that these people always kind of misunderstand, is there's a balance sheet equation to this. And yes, we can have debt and leverage in the economy, because when the government issues debt, that debt winds up into the economy, into the household, into household balance sheets, corporate balance sheets. That money's getting spent within the economy. And just like, you, Mike, you have a mortgage, people have mortgages. Your mortgage is probably, a good chunk of debt. I'm not saying you personally, but people have a mortgage debt that's pretty hefty in a lot of cases. Maybe they make $100,000 a year and they have a $300,000 mortgage. They're not bankrupt, right? Because you're paying that debt off over time. And that's the same thing that occurs here. So just because you have a high debt level doesn't mean that you're about to have economic ruin. Look at Japan, 280% of debt to GDP, they're still kicking along. So, if there's ever a microcosm of a country that's going to have a problem debt-wise, it would be Japan. And that's been that case for 30 years.
No, and actually you can make the opposite case that because our government is spending too much, it's weighing on the economy. It has a negative impact on the economy in the long run, which is disinflationary, some point maybe deflationary. So, one argument he could be making is that we're going to have an inflation problem, not hyperinflation problem, a deflation problem, which is arguably just as bad. It may not sound like it to you, to people, but from an economic point of view, that's a real problem. And look, if the U.S. debt continues to grow faster than the economy, he's right. Somewhere down the road, our grandkids, or when our kids are our age, may be dealing with this issue. But Lance, we're old enough. It's not our issue.
True. There are certain things that will become somebody else's problem down the road. Here's a chart, though, of Ray Dalio's debt crash is imminent. And this is part of the article that I discussed recently. Because this thing comes up, this conversation with him comes up about every 6 months. It keeps him in the media. So every time somebody wants to know about a debt crash, they call Ray Dalio so they can get a quote. But this is the chart. So again, if you just invest in the S&P 500 index, he has been constantly talking about, the end of the debt cycle, the crash is coming, 1937 repeat. So you go, oh, well, Ray Dalio said this, so I'm getting out of the market. You missed out on a lot of return in your portfolio worrying about things that A, he has no control over, B, there's no historical evidence of it being a problem, and C, that these are things that the economy can grow out of over time. And particularly as we continue to innovate, and particularly now that we're moving into artificial intelligence and whatever kind of this industrial revolution is going to look like next that we're going through, you can grow your way out of some of these debt problems over time. And this is why some of these things actually never occur, because the economy is dynamic. Things change over time. The markets adapt, the economy adapts, consumers adapt, things change. And there's an adaptation of those changes within the overall cycle, which prevents these end of the world type scenarios from occurring. And so the point about this is if you agree with Ray Dalio, it's fine. But when it comes to investing, don't let kind of these headlines that people have no control over lead you to make poor investment decisions, because it can cost you a lot of money over time.
I guess and my point is, look, I'm not disagreeing necessarily, but the timing is a huge issue. This isn't imminent. This is way, way down the road, assuming it continues, assuming the economy is the way it is. And we know the economy is changing rapidly right now. And again, we can look to Japan, that we're not even close to where Japan's at, and Japan is doing okay. So
yeah, here's a chart of debt to GDP of Japan versus the U.S. This is a little bit old. This article I wrote was about a year ago, so it's a little bit out of date, but not too much. But there's your spread.
It's roughly 2 to 1, right?
Yeah. So anyway, it's just important, as investors, and particularly look, a lot of you guys in chat, y'all love the doom and gloom stories. The end of the world's coming, blah blah blah. It's fine. There's nothing wrong with that, but just don't let it drive your investment decisions over time, because it can cost you more money. There's an old saying, I think Peter Lynch said, is that more money has been lost worrying about a crash than actually lost in the crash itself. And that's a really good analysis of kind of that, because again, if you got out of the markets back in 2014, it hurt you far more than the market's actually correcting. Because if you had a 50% correction from where we are now, you still wouldn't be back to where you were in 2014. So you've lost that time frame to grow your wealth and prepare yourself for retirement and do those type of things. And this is our focus. When we talk with you in the mornings and when we write articles and do all this type of stuff, we're generally taking these bigger discussions and breaking them down factually and saying, look, here's how the market works, here's how the economy works. It's okay to have a bias towards these more negative outcomes. The reality is, though, that those more negative outcomes rarely occur. And even if they occur, you can navigate through those. You don't have to be out of the market entirely and missing out on growing your wealth, because our job as investors, your job listening to the show this morning, our job in terms of managing money is to make sure that you're reaching your financial goals over time. And so it's important to set some of these narratives aside, break them down for what they really are, look at them for what they actually are, and then invest around them as you need to. Anyway, so just things to think about this morning, because again, this has been one of those narratives that's cropped back up in the last few days, and we've seen a bunch of it. So, Mike, I wanted to ask you a little bit about kind of the, talking about debt and those type of things. The kind of the cycle that we're in terms of the Fed cutting rates, where we are now, and just recently we added a little bit of mortgage-backed bond exposure to our portfolio. Kind of explain why that seems like a good idea where you are right now.
So when you look at bonds, right, you always start with treasury bonds. That's your foundation. And then let's just say corporate bonds. If you're going to buy an IBM corporate bond, right, it's not risk-free. The company can default, right? So you want a premium. You want to earn a higher yield than you would on a U.S. Treasury, which is risk-free. And you can laugh at the risk-free all you want, but it's considered risk-free in a market. So what's the premium? So when you go through corporate bonds, everything from AAA rated to junk rated, when you look at most municipal bonds, that yield premium is historically low. So the market isn't paying anyone to take corporate bonds or municipal bonds for the most part. That doesn't mean there aren't bonds that don't have value or are still worth picking up, because that yield premium is something on highly rated bonds. Mortgages are not nearly as tight as other sectors. So first of all, you can pick up additional yield. Now, the thing with mortgages is that there aren't any anymore. There are no home sales, right? I mean, the number of transactions is really small. So you have a limited supply. At the same time, you have Fannie and Freddie that are now being told to purchase $200 billion of mortgages. So that sets up a nice supply-demand dynamic that should help mortgage spreads come into treasury spreads. At the same time, there's the amount of supply of treasuries is shifting to the front end of the curve. So there's not a lot of longer duration treasuries either. So another place to find duration is in mortgages, because they have longer durations. So there's a lot of dynamics that are pushing that should help mortgages a little more than treasuries. We think treasury rates can keep coming down here. If this true-flation number is half correct, if inflation's 1.5%, not the 0.8, 0.9% they think it is, treasury rates are going to come down sharply, and mortgage rates are going to come down even quicker. So we shifted from IEI to MBB, the mortgage-backed security ETF, to pick up a little extra yield carry and probably extra return if prices were to rally.
And that's kind of the idea. Again, we've had our portfolio primarily weighted towards short duration bond exposure anyway because of the effect of the Fed cutting rates. That tends to actually factor in much faster than the short end of the curve. But even though just lately we've seen a very sharp rally in long duration bonds. It's been over the last couple of weeks in particular, since the last CPI report, we've seen yields come down pretty quickly. We're close to 4% just yesterday. So, we're still seeing that kind of range trap on the longer end. There's a lot of people predicting last year that interest rates were going to 6%, inflation was going to come surging, and we haven't seen any, and because of tariffs and more than anything else. But yeah, we haven't seen any of that factor through yet. And as we've talked about on the show, I think last week, talking about the Trueflation Index, is certainly starting to show more downward pressure in inflation than upward pressure. So it's been kind of an interesting scenario for the bond market. Hasn't really gone much of anywhere. So price-wise, bonds haven't changed much in price, but you've just been kind of collecting the yield. And they've actually become a bit of a better hedge during more volatile days. We've seen bonds actually step in and provide some volatility support as well.
And I was actually talking to a client yesterday, and he said, so how much more is the yield curve going to steepen? And I kind of shocked him. I said, honestly, I think the yield curve could start really flattening here. So the difference between, say, 2-year and 10-year treasuries could start converging on each other. And the reason is because, as we led, the Fed seems kind of stuck here with rates. Barring any big changes to inflation or to labor or to the economy, the front end of the curve, so the 2 years and in, are not going anywhere. They're all based on the Fed. At the same time, if we start seeing slowing, continued weakness in the labor market, and inflation keeps just drifting lower, which it has been. Let's just forget trueflation. Inflation expectations have been drifting lower, and CPI is 2.4%. It's not far from 2%. Fed funds are still at, 3.5 now?
Yep.
So that's still a restrictive rate that should be pressuring the economy to some degree. So because the front end of the curve is kind of anchored, we could see the back end fall, and that, we could get a flattening. I don't think we get an inversion again, but I don't think I think it's possible that those 10-year yields start heading towards where Fed funds are now.
Well, and again, we will get an inversion again at some point in the future.
Yeah,
right?
Not necessarily in this.
Cycle. not in short term for sure.
Exactly.
But yeah, if and when we actually get another recession at some point, yeah, you'll get an inverted yield curve, and of course that's going to be a whole different story at that point.
And if Warsh turns out to be, my concern is that Warsh, not concerned, but I think he could end up being a lot like Powell, which is going to give Trump a heart attack. But I as I said before, everybody thought Powell was going to be different. They're all the same once they get into office. So it's kind of like congressmen, right? I mean, they all say they're going to do something when they go to Washington. When they all get there, they're all the same. So I don't think too much difference. Hassett, like Moran, is really pushing for lower rates.
Sure.
But he didn't pick Hassett. He picked the more hawkish player. That so again, that's reason to think that even though we have a new Fed chair, he could just kind of take the throne right from Powell, and rates may just kind of stick around where they're at. Fed funds may stick around where they're at.
Yeah.
Which would further, probably add pressure for longer term yields falling.
And again, this is going to be, kind of things we have to navigate as we go forward. And again, this kind of goes back to our whole conversation this morning, is that, look, there's a lot of things to worry about. There's always things to worry about. We've got issues with Iran again, right? So those are popping back up. And immediately everybody's like, oh, we're going to go to war with Iran. Maybe not. Nobody really wants to. But, those are things we can't control, right? Those are things that we can worry about for sure. But those are things we can't control. And as investors, our job is simply to invest in the markets that we have right now, understand the market dynamics we have, and adapt to changes as they come. The market's going to tell you if there's a risk of war with Iran, The market's going to tell you that in advance. The markets are going to start moving in a direction relative to what's coming. You're not going to wake up one morning and the world declares that the U.S. is bankrupt and, oh my gosh, everything is going to be down 60-70% tomorrow morning. Markets don't work that way. So spend less time worrying about things you can't control and spend more time worrying about things you can control and making those adjustments, because you'll perform a lot better over time. And at the end of the day, that's all this is about, right? It's all about us just making money so that we can have the lifestyle that we want and the retirement that we want in the future. And we can do more damage to ourselves worrying about things that are way outside of our control than just dealing with the markets that we have and navigating our way as we go forward. So again, just try to set some of these. A lot of these headlines are great. People that have really bearish podcasts and those type of things, they get lots of views and clicks, and those kind of headlines that scare the bejeebers out of you are great for getting clicks and views, but it doesn't really help you. And if you want to be truly kind of thoughtful about how you're growing your wealth over time and getting to your goals, spend less time worrying about those things and spend more time worrying about what makes you money and your job and creating income and savings and those type of things, because you'll perform a lot better over time. All right.
I would just,
go ahead.
Lance, real quick, I would just add to it. The market knows everything you know. It knows everything we know, and it knows more. Ray Dalio knows a lot more about what's going on with Iran than we do. He has connections. So when you look at market prices, they are priced for everything they think is going to happen. So because you think we're going to invade Iran this weekend or next weekend, the market has thought that. It has priced it in. It is reflected in the price of oil that's up $3 or $4 over the last week or so. The S&P that hasn't really gone anywhere. It's in there. Now, obviously, we could invade Iran and things could change drastically. It could go good. It could go bad, which will have an impact. But the market is already priced for everything you know and everything we know, plus some.
Exactly. All right, that wraps up the show for the day. Be back tomorrow with Financial Fitness Friday. Of course, our newsletter will be out this weekend, so make sure you're subscribed to the website, realinvestmentadvice.com. Also, again, real easy. If you just go to Substack at Lance Roberts on Substack, we post everything there, our clips every day. The show is there, our newsletter, everything. It just kind of all in one place. If you want kind of an easy place to get everything, get it there. Also on our website, realinvestmentadvice.com. Have a great day. See you back here tomorrow.